Watch now. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the government is preparing to do the unthinkable. And what I want you to understand, in a matter of months, governments all around the world are also going to be faced with unthinkable decisions. Now, let's head over to Bloomberg, where we picked today's story up with a headline: as China's PBOC readies multi-billion yuan pool of bonds to sell by tapping major banks. And this is virtually unheard of, that a government would go to the banks to get bonds to dump on the market. The reason why is going to shock you. After months of investor speculation about its intentions, the People's Bank of China disclosed the clearest outline yet of its unprecedented plans in a statement here to Bloomberg. It said it had hundreds of billions of yuan worth of medium and long-term bonds at its disposal to borrow after signing agreements with several major financial institutions. And could you imagine the Federal Reserve going to the large commercial banks and saying, look, we need to borrow bonds from you? Well, what is the big plan the PBOC has? Well, it's to dump them on the market. The central bank said it would borrow the bonds on an open-ended, unsecured basis and sell them depending on market conditions. The reason why? Well, the PBOC thinks that interest rates in China are, get this, too low. Could you imagine that? If interest rates went down here in the U.S. and the Federal Reserve says we can't control them, we think this is a problem, so we're going to borrow bonds and dump them onto the market. If it seems ridiculous, well, it is. The PBOC's reply came after it signed an agreement with Industrial and Commercial Bank of China and was in talks with Postal Savings Bank of China to borrow bonds. Hundreds of billions are decent amounts when it comes to monetary operations. The intention is to sell mid to long end bonds, is in line with our expectation given the current bullishness in the bond market. So what's happening in China is that intermediate and long-term rates are going down, and Beijing does not like this. It doesn't want this to happen. So what they're trying to do is get interest rates to go up, but they don't have the tools to do that. So they're going to borrow bonds from the big commercial banks and dump them onto the markets, hoping to get all of the short sellers and speculators in the Chinese bond market to feel some pain and have to cover those shorts and start buying bonds. Because the issue here is that PBOC does not understand what its own bond market is telling it, and that its growth and inflation expectations are coming down. Interest rates need to fall, but rather than listen to this, the PBOC is focused on something else. It's called the yuan. And here you can see the China bond rally is pausing after the PBOC borrowing plan sent rates a little bit higher. But one thing that should continue to rally is your brokerage account. Look at this. We talked about this yesterday, the close of July 3rd, our CTA Timer Pro. Now, what we do is we look at the machine positioning, and when they get in the deep short position and price rallies against them, we tell our subscribers when to buy. Now, on July 3rd, we had 10 open trades. We added 2 on that day. Now, Momentum Timer Pro, we look at those technical signals like the RSI and the MACD, but we add a proprietary overlay to that and run it on multiple signal links. We went into, of course, Friday with 9 open trades and then added 11. Now look here, as of Friday, 12 open trades, 100% of them are up. We added 1 this weekend. Momentum Timer Pro, 20 open trades, 75% of them are up, and we added 1 of those on this weekend as well. And what do you get? Depending on when you sign up, you get the report, you get the signals, you get my opinion on the best trades. We give you the stop loss levels. We give you the tracking of the trades and the returns. We give you a weekly update on the stop loss levels. And here's the best thing, a 30-day free trial. If you want to know why our subscribers are so happy, look at those win rates. They're unheard of. Even successful traders are somewhere around 50% mark. We're beating that, and you can beat it too. We make it that easy. Links in the description below. Start trading, start making money, and we can make money up market, down market, even sideways, as China's sovereign bonds have surged this year on the back of the country's gloomy economic outlook and expectations for interest rate cuts. And that's exactly what happens when you have a debt-based economy, because when it starts to contract and shrink, which is evident by slowing growth and slowing inflation, the way you revive it is to get people to borrow and spend. Well, if interest rates are too high, people stop borrowing, and what the market in China China is trying to tell the PBOC is rates are too high. The issue here is if the PBOC starts to cut rates, they feel more money will leave China and go to the U.S. where rates are much, much higher, and that will, of course, put further downward pressure on the yuan, which we've noted they can't stop that free fall either. The lack of attractive alternatives and a switch out of savings to financial investments has fanned demand, and an increase in government borrowing to boost fiscal stimulus failed to put off buyers. Well, that's partially because the banks would rather buy government bonds instead of lending because they do not feel confident about the ability to get their money back, and instead they would rather have the safety and security of government bonds even at a lower interest rate. This is something the U.S. commercial banks will soon do as well. And here you can see the effect, of course, on interest rates and growth and inflation expectations. Looking at U.S. data, I took the consumer price index and merged it with the gross domestic product that's shown in blue, and I put that on a year-over-year rate of change against two-year treasury yields, and you can see the relationship here. As growth starts to rise, well, interest rates go up with it, and when growth slows, rates come down, except now growth and inflation expectations are falling and rates are rising because the market and the Fed believe rates need to not only be at current levels but even higher, and that's going to, of course, send the U.S. economy into recession. But what's happening in China is the same thing that's going to happen in the U.S. At some point, we're going to see rates start to move down. We saw the 2-year and the 5-year here on Friday start to make some moves down in the U.S., trying to indicate to the Fed you're on the cusp of a major policy mistake. In China, it's too late. The bond market's saying you're going to have a financial crisis here in the near term. And we see the effect of why rates in a debt-based economy matter so much as we look at commercial industrial lending, and this is shown in blue. This is a weekly data. We could look and note that on a year-over-year rate change is barely positive now, just above the zero mark. And again, this is looking against the 2-year treasury yield. And what's important to understand in a debt-based economy, when lending growth slows or even worse contracts when it gets underneath the black line, what it's telling you is rates are too high. And that's what's happening right now in the U.S. Rates are indeed too high, and it's on the edge of choking out the U.S. economy and the lending market. When that goes, well, things get bad really fast, because in a debt-based economy, when you see that blue line above the horizontal black line, that means on net banks are creating money, and they do that when they lend. But when it's underneath that horizontal black line, well, that means fewer loans are being originated than are on the books and being paid down, and money is indeed on net being destroyed. It sets up either you're in a recession or you're about to be. Pick the one you like, because that's what's coming soon. However, the PBOC has been pushing back against the rally, warning investors of potential losses that would happen if the market reverses. The central bank sees excessively low yields as endangering financial stability and weighing on the yuan. And indeed, that is true, because if the PBOC were to cut rates, the belief would be the yuan would continue to fall, and this would be dangerous because it would destabilize the Chinese economy and the entire region. The problem is a PBOC would rather sacrifice the economy, which means they're going to cut rates anyways, than do it now. It's a dangerous game. Of course, we know that China's property developers are insolvent. Their banks are right on the cusp of insolvency. And if one thing more goes wrong, well, the whole country is going to come crumbling down. And we think that hundreds of billions of amounts are likely to change the short-term momentum of the market, and that absolutely can happen. It's still difficult for the PBOC's action to change the long-term trend of bonds, because the fundamentals play a key role. And the fundamentals are saying not only is the Chinese economy slowing and heading into recession, the global economy is as well. And that's exactly what the bond market is saying. And here you can see kind of the effects of what happens when central banks keep rates artificially high, despite what the market is telling them. And this is what's happening in China. This is happening in the U.S. and all other major countries. And here you can see what we look at is the yield curve. This is in red, and this is shown inverted when 2-year yields are higher than 10-year yields. And when that happens, well, banks curtail their lending lending activity, as evident by the net percentage of domestic banks tightening standards for commercial and industrial loans to firms of all sizes, that's shown in blue. And so what that means is when a borrower goes in to get a loan, the bank is more likely to say no or make it extremely difficult, to the point where some borrowers walk away, or perhaps people don't get the loan they want. When that happens, you're not creating money in the economy, and it leads to a slowdown, because at some point the music stops and there's not enough money to maintain growth targets and pay on the debt. Next thing you know, delinquencies start to rise, they turn into defaults, and you're in an all-out recession. And we can see that effect here in the US. We know that's what's happening in China, because the bond market's telling the PBOC you need to cut rates. Forget about the yuan. You're going to have much bigger problems. And sure enough, that's exactly what happens here. You'll note that the red line steepens. This doesn't mean rates rise. It means rates, well, they start to fall. And here's that evidence as we look now just at the 2-year yields. As lending standards tighten and there's less money being created in the economy, well, to get people to go into the banks and borrow money and spend, rates need to go down. What it's telling us again is rates are indeed too high. And that's why when banks tighten lending standards, you see each and every time rates come down. They haven't happened yet because the Fed is adamant, and we're likely to see at the end of July, that they need to keep rates high. They're going to make a huge mistake. They're already making one now. They're setting the U.S. into a recession, and when we are, you're going to watch them cut rates as fast as they can. The problem is it'll be too little, too late, just as it always is. The agreement opens the door for the PBOC to intervene in the market to stem off volatility. However, the current scale seems like it is more for a cyclical purpose, as it will not be big enough to revert the market forces driven by economic rationale, such as the expectation of lower rates. The other factor here is if the PBOC, let's say, is successful at driving rates up a bit, all it's going to do is reduce demand and consumption even more, leading ultimately to even lower rates. This is a problem when governments intervene in the economy and with monetary policy and fiscal policy, because they think they know more than the market does. It's happened again in China, in Europe, in the US, and Japan, all over the world. And what we're going to face is a globally synchronized recession. And evident, of course, rates are always right, and PBOC's got it wrong. Let's take a look now back at the U.S. data, because even in the short term, the PBOC may be able to get rates back up, but it's not going to last. Here we look at the federal funds rate in blue against 2-year treasury yields, and you can see the 2-year yields. They tell the central bankers what to do and when to do it. And right now, 2-year yields remain below the funds rate, and if they start making a large move down, as you can see evident in the past, well, what that means is the Fed is going to be cutting in a major way. And the evidence course goes on as U.S. bond yields fall, as jobs data fuels bets on 2024 Fed cuts. It's going to be more than that, because when historically the Fed begins to cut rates, well, they can't stop, because it means we're in a recession. But the market is convinced here that the U.S. economy is strong and robust and just needs a couple rate cuts to get consumers back out to spend. What they don't realize is the labor market is teetering on the edge of abyss. And of course, the non-farm payroll report makes things look fairly good, but underneath that, we see continued unemployment claims start to head higher. That is the red flag that says we're in the danger zone. I think the rally does have room to run, deferring to the economy. The Fed has a very strong bias to embark on a mild easing cycle as labor comes back into better balance and inflation may surprise to the downside. Well, with the more people you have on unemployment, indeed, you're going to get inflation to the downside. But the notion that you could put people on the unemployment line and bring the economy into balance and then start to turn it around, not likely to happen, because once you start stacking workers on the unemployment line in a period where inflation is still relatively high and debt service costs are high, their consumption drops, and that means other people are indeed going to head over to the unemployment line as well. And you can see the effect. The bond market knows this is coming as well. As we look at continued unemployment claims, focusing here on the weekly data instead of the monthly non-farm payroll report, because we get a much more accurate picture right now as we look at the market yield on 2-year treasuries, and you can see as continued claims start to rise, yields come down. And it makes sense because what you need is people to go out and consume and borrow money and spend and put that into the economy, and that gets people back into the workforce as demand goes up. And that's why you see this relationship happen each and every time, except now, once again, the Fed and the market in the U.S. believes rates need to stay elevated, and now we're starting to see continued claims tick higher. If you see this break over 1.9 million claims, watch out. That means initial claims will follow and yields will come tumbling down just as they do each and every time. And some other evidence the U.S. economy is in danger as U.S. factory orders unexpectedly tumbled in May. And we're going to see a lot of this term unexpectedly, and not just on the headlines of my show, but as everyone starts to realize that the U.S. economy was not ever as strong and robust as believed. It had everything to do with lingering pandemic stimulus money still floating around the economy and people borrowing money on these for-pay loans and maxing out their credit cards. Now that it's all gone, the economy, well, is about to trip all over itself. And to cap a day of serially ugly U.S. macro data, Zero Hedge notes that factory orders unexpectedly plunged minus 0.5% in May, and this will send people onto the unemployment line and cut hours as manufacturers look to cut expenses. The year-over-year rise in factory orders is just 0.9%. Remember, that's nominal. It means it doesn't factor inflation. So in reality, factory orders are tumbling on a real or inflationary basis. And after 3 strong months, even core factory orders also dropped, tumbling minus 0.7 month over month. So you can see the effects of higher interest rates here. Now, notably, the Fed isn't going to borrow bonds and dump them in the economy to drive rates up. They're going to be slashing rates. The problem is, by the time they do, there's going to be too many Americans on the unemployment line. And the bond market, you can see the response it has and why it's a problem that the Fed is keeping rates up, why investors continue to drive rates in the U.S. higher. You look at manufacturers' new orders of durable goods as shown in blue on a year-over-year rate of change against the 2-year treasury yields. And you can see as new order growth goes down, as demand falls, how do you get demand in a debt-based economy to turn around? Well, you need lower rates. Of course, this is the one time rates are still in an upward trend as new order growth is headed down, likely to get into contraction at some point. And that means, again, more workers are going to get their hours cut. There's going to be less pay growth, and of course, more people headed to the unemployment line. And it won't be long before we see headlines like this that are happening in Germany, in the U.S. As industrial output unexpectedly sinks, as rebound struggles, as output fell 2.5% from the previous month, while April was revised up to a slightly positive reading, May's outcome was below all estimates. Look at this, cars, machinery production, electrical equipment all saw drops of more than 5%. Can you imagine that happens here in the U.S.? The figures come on the back of release Thursday showing a surprise slump in factory orders in May, and this coincides with the fact we look around the world's economy. What happened? The U.S. consumer in May all of a sudden was tapped out and is now starting to have effects all over the world as the world's largest consumer now is starting to retrench. The latest numbers for German investor sentiment also fell short of expectations, as did a gauge of private sector business activity. And along with the latest weakening of business expectations in manufacturing, the persistent declines in orders suggest rather muted momentum in the coming months. No second half rebound, no soft landing. Production will only stabilize when global trade recovers further and demand for industrial good revives. The problem is the U.S. economy is heading into recession. The Fed's got rates too tight. China's trying to drive rates higher, if you could only imagine that. They're doing what I think is the unthinkable. They're going to actually do more damage to their economy, and all in the name of saving the yuan, which is going to continue to plummet until the dollar reverses. When will that happen? Well, according to the market, when the Fed cuts, and that answer is not in July, which means we're teeing up a September potential cut. By then, it's going to be too little too late. And watch the Fed and the U.S. government and other governments around the world faced with doing the unthinkable. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.